My name is Koketso Chipane. I'm an equity derivative specialist from our capital markets team. And I'm just standing here to introduce our speaker for tonight, Singer from Vunani Private Clients, one of our very most valued clients. He's going to shed some light on how to read financial results like a pro, which is, I think, a subject that a lot of us take for granted, but it's very important. So without wasting any time, I'm going to call over Singer to present for us. Thank you.
Thanks, Koketso. Good evening, ladies and gentlemen. Thanks for coming through to this presentation. All right. Today we're doing how to read results like a veteran in the market. The purpose of this presentation is to not really turn you into a guru overnight, but to really try and accommodate everyone who at different levels in terms of their knowledge of the market. This is just like a guideline on the checklist that people who watch the market normally look at to scan through the results of a company and get a feel of how it would perhaps perform on a day that it drops their results, where you as a trader could perhaps take a position, be long or short. If you've scanned through our checklist, you should get a sort of good sense and measurement of how the share could trade on the day. So let's get on with it. So this is basically context. We've segmented this checklist with steps. It's step 1 to 5 to 10 actually. Step 1 is really how to decipher previous reporting results. Step 2, what the company revenue tells you, and so forth. But I'll go through the steps individually. So step 1, how to decipher previous reporting results. Now, this is when you go to the last reporting period of the company. You can look at the trading statement, or you can look at the company annual results. Just you jump straight to the chairman's letter. Normally, the chairman would write a letter to give an indication of how the company is doing and also what their objectives are. So when you look at, for example, now we are in October, our reporting season starts again in November. Our last reporting season was between June and August. So you could first go into the August results and see what sort of objectives, what sort of guideline did management give, and see if have they achieved that in the current results. I think that's a good starting point. So that's basically what I've just said now. Has the company met its previous objectives? You'll find this information in the trading statements and annual reports and chairman's letters to shareholders. This really set the scenes for the current results that you are looking at. If for example none of the objectives were met, then you will immediately get an indication what sort of results you're looking at, because here you're trying to scan through results without reading the entire 400-page document to get the sense of how the share will trade on the day it drops results. So key takeaway here is if company previous guidance was met, then you can be confident that you can be confident about the management's ability to meet future expectations. That shows you that previous strategies have worked, and that gives credence to the current results. And also the opposite is true, So that's I think that's our first checklist you should take note of. Step 2, this is the crux of the business. How does a business make money? What is the revenue model? So you must really look at that number and see what it tells you. So here we've just put a little picture just to give you an example. This was, I think this is Aspen's last reporting annual report. Yeah, you can see that the revenue has grown by 53%. So what is revenue? Revenue is basically sales, because each company, they can be selling a service, or they can be selling a product like computers or food or whatever it is. In order for the company to survive and grow and be profitable, it needs to sell what it intends to sell to its relevant customer. So basically, if the sales revenue is growing, like we can see in the example here, 53% revenue growth, it tells you that this company is not growing. It's growing. It's not shrinking. So what you need to be aware of when you're looking at the revenue number is to strip out any distortions to that number. Distortions could come in the form of acquisitions. They could come in the form of asset disposal if there was a business that was sold. So it looks like the company has recorded abnormal earnings, whereas those earnings were only pushed by the sale of that asset. So you must always look out for that thing. So whenever you see a revenue number, you must just check from what was the last previous reporting period's revenue and see at what percentage growth did it rise or fall. And then if it's too high, then you then start questioning if was there any distortion to this number. So that's what I mean there. This will give you a sense of the operational or efficiencies of the company. Obviously, if the company is able to grow its sales, it means that they're doing something right. Operational efficiencies, though, could be impacted by a few things. A company could enter a new geographical area where it increases its market shares, therefore the sales volumes, they go up, or the company could manage their cost pretty well, that the cost line comes down and their revenues increase. So there's different ways that companies try and embark on to manipulate that revenue number to look good. So you as an investor, you always look at results with cynicism, so that you don't get tricked into thinking that the results are great when they're not really great. Again, you will find this information in trading statements or the annual results. All JSE listed companies they are forced to report on the revenue number. Again, another thing that is important when you look at a revenue growth of a company or a decline is by what percentage did it beat inflation, at least, because we know that inflation it determines the value of money over time. So if the revenue beats inflation, it means that the company perhaps has the pricing power, has the ability to pass that inflation to a customer. Therefore, the customers that they're servicing are not price sensitive. They're still willing to buy, even though prices maybe would go higher than inflation. So that means that they're selling a product that's really in demand. So that immediately tells you that you're looking at a good company here. Again, if the opposite happens, then a couple of things that you should get out of that. Could mean that if the revenue doesn't beat inflation, it means that the sales could have dropped perhaps, or the customer might have been price sensitive and switched to a substitute product that is perhaps less cheaper. So again, it goes back to the company on how are they gonna shape their business to sort of avoid price sensitivities of customers and maintain their sales volume. And again, if the revenue has dropped, then it means that market share could be shrinking as well. That also goes back to how the company is shaping and positioning itself out there in the market. What sort of strategies have they got in terms of maybe marketing and then positioning themselves in order to be attractive in the eyes of a customer, because it's a customer that actually increases the revenue line of a business. Okay, step 3, what are companies' profit margin? So this step 3 is very linked to step 2 because a profit margin is really a percentage of how much of those sales were turned into profit. Let's just go into it quickly. Again, this is a measure of profitability. It's a percentage of selling price that turned into a profit. It's a good indicator of the company's pricing strategies as well as how it controls costs. So a company that's able to contain its cost but is able to increase its sales and sell to larger customers and be able to price higher and still sell more will definitely report a strong profit margin number. So that should immediately tell you that this company is doing well, and that will definitely have an influence on how it should trade going forward. Profit margins, again, they indicate the company's pricing power, as I've mentioned in the last slide. They also indicate the economies of scale benefits that the company would probably have. That reflects to like operational efficiencies. If you look at companies like, for example, SAB, that's got a wide network of distribution across Africa, they are able to to distribute at a much lower cost their product than any brewery that's existing in the continent. So those kind of things they would be reflected on the profit margins of the company. That number would tell you if economies of scale benefits are there and they're working. And also the life stage of a company. You've got a company that's a sort of in an incubation state, and you've got a growing company, and then you've got matured company. For example, if you look at retailers, clothing retailers, it's sort of like a mature industry because it's just the competition is quite rough. But there are industries where there's still a huge scope for growth. It's still sort of like a new industry that has come through. Even if you look, for example, at what's new now in this millennium, it's social networks. A lot of social networks companies that are coming to the fore, they are still in a sort of growth phase. But at some stage, a company goes into maturity. So also a life stage of a company would sort of dictate what profit margins they should be making. So you must always view, you cannot compare a company in a mature stage to a company that is in a growing stage. For example, again, if we use, let's say, telecoms, we use a company like MTN. In South Africa, telecoms, there is quite strong competition from other companies like Vodacom and perhaps Cell C in a slight extent and Telkom. But if you look outside South Africa, you'd find that MTN is dominant. So in other regions where they're operating, they're still growth companies. Therefore, the profit margins would be slightly higher than they would record here in South Africa, where they're sort of in a mature stage. So that's what we mean there. Also, again, differences would really, companies' profit margin differences would come from how they've approached the market in terms of their competitive strategies. Competitive strategies, we mean like, has the company got a cost focus, or is it have they got like a differentiated focus? You've got companies like, if you look at retailers, you look at Woolworths. Woolworths is differentiated from Pick n Pay or ShopRite. They have a niche customer, they price for that niche customer, so they have a differentiated focus, whereas ShopRite is cost focused. They want to attract each and every customer that is concerned about costs. Yeah. So that's what we mean there. Key point to take away is try and invest in a company, in a growth company that has the ability to increase its profit margins, because share price growth usually follow earnings growth. Step 4, discover the one figure that indicates the company's performance. Here again, it's really about operational efficiencies, the operational model. How well is this company operating, and how consistent is that? So we look at headline earnings. Again, according to the reporting standards of South Africa, this is the one figure that each and every company must report in their top line. It must come out at the top of their results. Headline earnings. What is headline earnings? It's a measurement of a company's earnings based solely on operational capital and investments. So what it does, what the headline earnings number do, it strips out, it takes out all the non-operational profits and losses. For example, what could be a non-operational profit and loss? It could be, let's say, for example, from a loss side, there could be, let's say, a strike that took about 2 months. So that would perhaps lead to a company, generating less profit margins, than if it was normal. And what could be, on the profit side, it could be maybe a one-time contract that the company has got. but that won't be repeatable in the future. So you must just watch out for those things. Also, an asset disposal also forms part of those non-operational gains where you will not be able to repeat that performance. So what you really need to look out for here is a rising headline earnings per share is better than a falling one. What other things that affect headline earnings number is if a company perhaps issues out shares in order to fund a new investment. Here, if company issues out share, then headline earnings number would be lower because they've got now more shares. They've got now more investors, who are trying to get a slice of this pie than they had before. So it's not always a negative to see a headline earnings number down, but you need to understand why. If company issues out shares to fund growth and to fund growth maybe in a different geographical area, you shouldn't look at that as a huge negative. Essentially, headline earnings per share movement should be correlated to profit. So a profitable company would have an increasing headline earnings number. And then here we say learn to read commentary that reveals company sentiment. So this is now where you jump to management commentary of the current results, just to get the sense of how they feel about the results. You must always be aware of the fact that management will come out and try to sound as possible as positive as possible, so that it looks like they've done a great job, because no one wants to be told that they haven't done a great job. You know what I mean? So you must just be careful of those biases. The key takeaway here is to see if management explicitly highlights the possible risk that could affect profitability of the company. A good management would always highlight the good and the bad. They will always try to have sort of a balanced view of the company, and not just try to look good and don't mention anything that's negative about the company. Because if they do so, then they're hiding something, and if there's something to hide, then there's a huge flag of risk there. Then you should probably not try and put your money into that kind of share. So again, here you will have to use your own judgment of what you read. It will be very subjective. It's difficult to say this is the right thing they should say, this is the wrong thing they should say. It's really subjective. But what is important for me is that it is balanced and it is realistic, and the commentary is impartial. So this commentary should help you see if the management is hiding anything, as I mentioned before, because if they've got something to hide, then something is wrong there. Step 6, how to determine earnings consistency. Again, when you run a business, I think consistency is the name of the game. You want to run a business that you can be able to repeat your performance over time, so that you can be able to grow over time. It's all about trying to grow, trying to sustain your earnings for the future, not just for the current reporting quarter. So again, here you need to look out for once-off events that could seriously distort results. We've mentioned this before. Anything that's abnormal, that if you see a huge jump in profits or revenue, then you need to start going to look and see if is there perhaps any abnormal event or once-off event that could have lifted that number up. As we mentioned here, consider unusual transactions, and the management would always they are regulated. They're forced to comment on an unusual transaction that occurred during a reporting period. So again, sustainable earnings growth means consistent growth. This will give you a true reflection of how the company will grow in the future and grow its sustainable earnings. Step 7, liabilities you need to watch for. Companies would always have liabilities. They would always have liabilities, maybe from a growth point of view, where they've borrowed money to try and buy another business in order to grow, or to try and go into a new geographical area, or they would have liabilities based on legal issues that they may be facing. They could have, for example, Competition Commission, running after them. Who knows? Anything could happen in this business world. So you always need to go and have a look at what liabilities are these companies facing. And then there are good and bad liabilities, so you need to be aware of that. For example, here we say capex considerations. What is capex? Capex is capital expenditure. At some point, in order to grow your business, you need to spend some money, increasing your capital spend, whether you're buying new machines or you're buying new businesses or new buildings, or you're spending money on getting more people in your business so that you can have a bigger force. So there's always at some point of the other, or there'll always be a capex taking place in a business. So you need to look at how is this capex going to be financed. Is the company going to use their cash reserves, which affects what anyone wants to guess? Yeah, it does, and not necessarily. Dividends. Anyway, we'll go to dividends later. Yeah, so you need to look at where is this cash going to come from to finance the capital expenditure? Is it going to be cash reserves? Is it going to be debt, or is it otherwise maybe a combination of debt and equity or any other form of finance? Because there's plenty. If it's debt, then it will imply that there could be an increasing interest payments that the company needs to make going forward. So you need to be aware of that. And also, if those finance charges synonymous to interest costs, is the same thing. If finance charges are increasing, it means that anyone who's been borrowing money to that business is viewing them as a high-risk business. So if it's a high-risk business, should you be investing in it? Those are questions you need to ask yourself. So we just gave a ratio here that helps you to have a look and see if the company can actually afford to borrow money in order to try and grow their business, which is the interest coverage ratio. It helps you to determine how easy a company can pay its expenses over a period. Let's say a period is 1 year. If obviously they've got an interest coverage ratio of 1, that's fair, that's okay. If it's below 1, then the company might be struggling to repay their interest costs. So you need to just be aware of that as well. We did an example here, company XYZ, this is their net income, this is their interest expense. If you use the formula, EBIT over interest, this is what you get. This company is able to pay its interest payment 1.8 times per period, which is fairly safe. It makes this company a safe company to invest in or borrow money to, because they've got the ability to service their debt. Step 8, the one figure you need to define your earnings potential. Okay, this is what we call return on equity. This is one other most important number that investors and market watchers and everybody who participates in the stock market watches, because it tells you exactly how does a company deploy your capital that you've invested in them in order to make you money as a shareholder. So it indicates how well a company management is deploying the shareholders' capital. Return on equity is more a measure of profit. It's a measure of efficiency. So obviously, a company that is operationally sound, that has got a consistent operational model that is able to deliver profit time and time again, they will have a higher return on earnings. A rising ROE suggests that the company is increasing its ability to generate profit without needing as much capital, without using debt. Falling ROE is usually a problem, so it's a very, very important number. Just two examples here of companies that have higher return on equity. MTN is one of them. First Rand is one of them. Coronation is one of them. This is a ROE formula. It's basically net income. What the net income is the income that the company has made after taking all the expenses off, and shareholders' equity. That's the capital that came from shareholders. So if you want to do, for example, for yourself to see what company XYZ's ROE, you can say in our example, we've got here 10 million net income and 20 million shareholders capital, which gives us a return on equity of 50%. So it means that, you know, for each and every R1 you would have invested in the company, you would get 50 cents as a return. So key points here again are write-downs, share pullbacks can artificially boost ROE. So what this essentially means is a write-down is if a company scraps an asset or sells an asset and therefore records a higher net income of which they haven't been operationally, you know, great, but they just sold an asset to boost that net income to increase that ROE number. And share buybacks can also artificially boost ROE. When a company goes out and say we're going to buy back all the shares that are currently held by the investing public. So what that will essentially do is it will decrease that 20 million number you see there maybe by 20% or so. Therefore, that would increase the bottom line there of 50% maybe to like 60%. Whereas they haven't necessarily done anything great operationally. Maybe they haven't been innovative or brought a new product or tried a new marketing strategy, but they just played around with those figures. So that's things you need to be aware of. And also, when you're comparing ROEs across companies, you must always compare companies in the same industry. So if you're looking at MTN, must compare it with Vodacom and Telkom. If you're looking at retailers, let's compare ShopRite with Pick and Pay and Woolies and any other retailer. But you must always segment that sort of thing. Step 9, autopilot of moneymaker. This is the reason why people invest. You invest because you're expecting a dividend. You buy a company because it must share what it has made with you in the form of dividend. So it's a payment made by a corporation to its shareholders, usually as a distribution of profit. So when a company makes profit, it pays a dividend. A company that doesn't make profit will struggle to pay a dividend. Even though some companies would stick to their dividend policy and try and pay dividend even though they haven't made money, it means that they have to get that money somewhere else, maybe in the form of issuing out more shares or getting into more debt, which should be a problem, which should be a red flag for you. So that should worry you if you're trying to invest in that company or you're already invested in that company. So here, this is the main reason why people buy shares, because they're expecting to earn a dividend out of that. So the questions you need to ask is, company paying dividend before you invest or before you trade? Would I get a dividend here? Is there a dividend policy? Has it always maintained that dividend, or does it pay it 1 year and then it drops the second year? So immediately you know this is not a consistent operator. Dividends paid from company profits, therefore, you know, are they sustainable or are they borrowing money to cover that dividend? Is the company paying a progressive dividends? That means that is the dividend that you earn over time, does it grow or is it flat or is it actually shrinking? Is the company increasing or decreasing over a period of time? Yes. Examples of high dividend paying companies, for example, Sasol. We've seen how Sasol has grown to be, you know, a global energy company over time, and its dividend growth has also, you know, followed that track. Another stock that has been paying a fairly good dividend is Kumba, because it's done well over the past years, but we don't know now what could happen given the iron ore price situation. Vodacom is also paying quite a healthy dividend because you know, over the past 20 years they've been able to grow their business and capture more clients at the higher end of the spectrum. So that has helped them to be able to pay, you know, a better dividend than other companies. So those are sort of things you need to look at when you look at a dividend and the company's dividend policy. These are the questions you should have. Step 10, which takes us to our last step, is how to declare the company's prospects. Again, management, they have to report on how, they have to give investors guidance on how they think they will operate, how they think they will do in the next quarter to 6 months, so that, you as an investor, you're at liberty to make an informed decision before investing or trading in a share. So here, again, you need to just take steps 1 to 9 into account. Consider if management is sound and optimistic, or are they pessimistic about the future? Because again, you want to follow someone who's encouraging them, but then someone who's pessimistic. So is their tone appropriate? You can't report quite horrible numbers and be very optimistic. Those are two divergent sort of emotions. So you just need to get a sense and see if there's a balance there. If the results are a disaster but management is massively optimistic, that should raise a flag for you. Often management will try and strike a balance between how tough environment is, because of any downside, that is not their fault. They always blame the environment. They always, you must always be aware of that. It's not going to be them or a decision that they made operationally that could have affected their results. It's always going to be maybe things outside their control. So, you must just be aware that, these kind of statements or commentary will have those kind of statements. So again, you maybe try and ignore those cliched balanced remarks and rather focus on, on the numbers that we've mentioned, from the earlier slides. If profit margins, revenues are growing, ROE is growing, dividend is growing, because again, management will try and sound as good as they can be. We've put in an example here. If the prospect section of a coal mining company, I would know all comments how tough mining in South Africa is and how soft the coal price is. We already know that. It's always in the news. Every news channel will tell you where the commodity prices are trading, but rather you should focus on things that would help the company get out of troubles or doldrums. If it's in the doldrums, maybe in the form of, are they going to try and close, old mines to cut costs, or are they going to acquire new mines to increase the revenue base? What's on the pipeline? What is this company focusing on in order to try and draw than just commenting and telling us how bad it has been, because we already know that. So this directly affect the company's earnings over the short term, and that brings us to the end of our presentation. So again, as we mentioned, this is just general guideline. If one wants to do like a detailed equity analysis, they can definitely do so, but this is just at basic level. So again, we're saying that if company results, if you've got your checklist and you can tick at least 7 out of 10 on those, then that's not a bad company. If you can take all 10 of them, then that's probably a great company to invest your money in. And thank you very much for attending. Here's our contact details. If you've got questions, you can fire.